All right, everybody, welcome back. In this video, we're going to continue the discussion about paper trading in this video, which is paper trading number 3, introduction to paper trading. Now, in part 1, I just kind of introduced paper a little bit. In part 2, we kind of talked about options. Here in part 3, we're going to talk a little bit about futures. I constantly see new traders coming in, and the first thing that they want to do is fire up the computer, turn on some charts, and attempt to paper trade, as if you're really going to get anything out of that. So, let's kind of back up a little bit and think about what is the goal here, right? If the goal is to learn how to trade in futures, then you probably want to learn about trading in futures before you actually attempt to trade, live or otherwise, right? So it's not the idea that you can learn about futures from paper. You first need to actually go and do some research. So what we're looking at here is a little bit about paper trading. This is something that I spent time writing out in the earlier part of today. So paper trading. You want to get a paper and pen. Consider what you're interested in trading. Now, this could be a really long list if you've been trading for a while, or it could be a very small list if you're new to trading in general. It really depends on you, and it depends on how much skill you have so far at trading and how much knowledge you have about trading. What's your knowledge on candle patterns, on candles and wicks and bodies and trade setups? If you don't have any of that, what are you actually going to attempt to trade in paper, right? Suppose we were interested in trading reversal patterns. Today, for an example, was a range day, and reversals would be a good idea to trade on a range day. If I wanted to consider reversal patterns, I'd want to think, all right, well, which reversal patterns do I already know about? And do any of those fit what I think we could get for a trading day today? One reversal pattern that's really popular is the head and shoulders pattern. Now, if you think about the head and shoulders, however, if we're using something like a 4,500 tick chart, there's very likely not going to be enough candles there to actually give me an inverse head or a head and shoulders or inverse, either one, right? So that one is a good one, but depending on the time frame that you're going to be trading, you might not get a head and shoulders. It's not exactly something that pops up every hour or so. So I'd want to think about, okay, what reversal signals do I know? Would any of them fit? Another reversal pattern is a rejection off of the pivot points. Now, this one would fit in today's price action, and I've got pictures when we scroll down, but we were going to be trading today inside of yesterday's range. And so that means we have a lot of pivot points, universal pivot points that would be at our disposal. Think about some of the common universal pivot points. We've already discussed them in this chat, in this Discord. But for those of you who aren't in here and have not yet gone through that, think about what a universal pivot point would be, right? Or yeah, we'll call it a universal pivot. So yesterday's high, low, close, the Globex open, the RTH open, all of those would be considered an institutional pivot point. And if we're inside of yesterday's day, then you would have to anticipate that we would hit at least some of those. So how do we trade a reversal off of a pivot point? That's a high probability trade, and it's pretty common, and it doesn't require extensive background in trading to be able to identify it and or play it. So if that's the trade, then I would then want to begin thinking about, okay, I know what the pattern or the setup is. Now I want to take the time to map out where those opportunities could show up. And that way the trade doesn't sneak up on me, right? If we're going to go up and hit yesterday's high, for an example, I'm not going to just find price at yesterday's high. It's going to have to work to get there. So I'll see it moving in that direction. It's not like it's a surprise, right? If you've marked it out and you know where it is and you see price moving in that direction, you can plan and prepare to take a trade there. This is a really great way to approach a trade. It gives you control of your day back. You don't have to sit in front of the computer all day long waiting and hoping that price might eventually sort of give you a trade that you can take. You can map out where that trade is, set some price alerts to let you know price is getting in that area, and then you can do something else. Read a book, spend time with the family, whatever it is you happen to do. And then when the alert goes off, you can come in and you've already got your plan and you could take the trade. So planning your trade helps you avoid FOMO. It allows you to patiently consider a respected and a researched trade. It gives you time to measure out your money management. It frees up your day to accomplish other tasks, and it gives you time to review any old trades that you've done that match this kind of setup so that you can refamiliarize yourself with the plan and the strategy, some old examples, right? And kind of mentally prepare to take that trade. So here's a picture where I had mapped out the 5x5 is what we call it, but I mapped out my trading day. And you can see this was taken before they opened. So it was around 9:10 or so. And I've got all of these white lines marking out my pivots. We're just a few minutes before they open, but we're now ready to go. When we get into the trading day, you can see where price was around 41.05. We weren't at the low of the day. We weren't at the high of the previous day. We weren't exactly in the middle, but we were sitting pretty close to it. Plenty of pivot points there, right? There's like 7 pivot points. So as I wrote here, the picture above, I marked out a few pivot points for the trading day. Since we are opening inside of yesterday's range, I want to consider range day trades and any indicators that work well for performing analysis in a range-bound market. Now, I personally don't do that. I don't use indicators to do that measurement. I don't need them. But indicators are designed to help you read price. So if you can't read price on your own, turn on something that will help you do that. Give that some real thought, right? So here in this picture, the day was already done. The first picture was done when we were still in Globex, but getting ready to open. And this picture was taken after the close at the end of the day. It was a range day, just like we had anticipated that it was going to be a range day. And although I didn't mark it, I will point out that there is an inverse head and shoulders right there, right? And it reached 50%, consolidated, and then it hit 100%. So while I didn't mark that in the picture that we'll be looking at here in a minute, there was that trade as well, right? So plenty of trades here. So another thing that I mentioned here, written underneath the picture, is notice how price did not stop to the tick on these lines. Why would it? Price doesn't know that I drew a line there. Price does not promise that it's going to stop there. Liquidity exists on the other side of the line. So when price was running up towards yesterday's high, the high of yesterday, we can see it marked out right there. When price was running up there, the liquidity was on the other side. So it made sense that price was going to go through that line first. And then if we were going to reject, then we would reject. Or it would make sense that we just don't get there at all, right? That price fails to get there and that we fall back the other direction without ever having hit it. What it does not make sense to see is for price to run right up to that line and stop at the line, exactly on the line, let you in with a perfect trade, and then see it moving in the other direction. That doesn't make any sense. Why would price do that? Why would you even expect price to do that? So notice when price came down to 4,100, that was the low of the Globex session. We had hit it right there. When price came back down to that line, it went right through it. Now, earlier in the Globex, when price stopped there, it didn't hit this pivot and stop there. It made that pivot when it stopped there. And then later on, we marked it as the Globex low. So really consider what you're trying to trade. If you're trading a pivot point strategy, go back and find old examples where price has already done that before and learn to recognize and find a trade opportunity for that behavior. And teach yourself to recognize that while you may find examples where price did stop right on the line perfectly and exactly, that's not the base case, right? It's not what we would expect to see most of the time. If you get it, great, fine, wonderful. But you shouldn't expect to get it because liquidity's on the other side of the line. All right, so here I took some pictures, all right, I marked some of my drawings here that I see trade opportunities to take, right? We bounced on the RTH open. We had that reversal off of the Globex lows. We had a failure to reach yesterday's highs. We also broke out of the Globex open and then failed to keep it and came back down again. Here, reversal off the highs in multiple locations. Here, a rejection off of the open from that Globex. All these different trades, right? We had a trend line breakover and a Busby on the trend line breakover. All these different trade opportunities. And we already had our bias that it was going to be a range day, which is exactly what we got, right? Because we are inside of yesterday's price action. This was yesterday's the previous day, not yesterday, but the day before. It was the high of that day, right? So that was also the Globex low. It was two different pivot points wrapped together. So we had a really nice range to trade in today, and there were plenty of opportunities to trade in there. Now here's a close-up of that same low, the 4100 pivot where we set in the Globex, and then we had the RTH cash open, and we ran right back down there and retested that pivot. Now that's a double bottom. And with double bottoms, you very often see price go lower than the previous low. It's designed to trap shorts. Then when it rallies, all those shorts have to buy back to get out. And that makes it rally even harder, even faster, even stronger. And that's exactly what we got here, right? So a double bottom, exactly like we would expect to see, lower than the previous low with a 2-bar reversal and a run right back up again. The question for you would be, if you were trading a pivot point strategy, how would you get into this trade? Not how I would get into this trade, because you're not me. You can't trade like me. You don't want to trade like me. You want to trade like you. So your question would be, how can I develop a trade plan to take advantage of this? The pivot said that this was a reversal zone, and we did reverse there, and that was the low of the day when we ran and went the other direction. So it was something we could see coming. It was something that we could plan for. It was something that we could execute, and it offered us that. Now, how would you trade that? Here's another example of that same spot. There's the 4100 bounce. There's the cash open and a run down to those lows. The only difference here is I changed the time frame. We were on a 4500 tick chart. Now we're on a 250 tick chart. Look at that consolidation along the lows. Now we've got a bear flag failure. We came down, built a base, broke that base, got a trend line breakover, a TRB, Busby off of the base, and away we went back towards the open. Now, I see a lot of trades in here because this is one of my favorites. It's one of my go-tos. The idea, however, is that you see trades in there. How would you trade that reversal? It's the same reversal that we saw up here, right? It's the same trading day from what we saw way up here, okay? And we anticipated this trading day when it was all the way back here in the cash, in the Globex. So the idea is, if you're going to paper trade, you really need to have an idea of what is it you're actually trying to trade. There are a lot of ways to trade. A new trader needs to identify the trade they're going to focus on. With time, with experience, and with training, more trades can be added to the toolbox. And eventually, a trader has enough trades to hit their daily goal and their weekly goal. I call this writing the playbook. There needs to be specifics on what the trade is, but you want to make sure that you don't make your how to trade so complex that you miss the play, right? So you want a lot of detail on what the trade is, a lot of research, a lot of information, and a lot of knowledge. But when it comes down to how am I actually going to take this trade, make sure that it's concise and very clear. You don't want a lot of ambiguity and muddy. You don't want to muddy the waters there. The entry needs to be very clear and specific. So let's go through the steps. Identify a market behavior. Go back and document that market behavior and identify what your edge is. Research that behavior for insight. You're looking for things that will enlighten you and help you understand this behavior better. Find old examples of this behavior. During the research process, take pictures of the old behavior. Measure those old examples with your favorite indicators if you're an indicator trader. Ask questions about the old behavior and try to answer as many of those questions as you can through review and through research. You're on the hunt to learn and document and record and teach yourself about a particular market behavior. And your answers should come through your hard work, not sitting in a chat room asking somebody else about how they trade that behavior. We've been talking about trading a universal pivot point. Well, there's a lot of pivot points out there. Floor pivots, there's persons pivots, high-low close pivots. There's just looking left and marking a pivot. There's so many different pivot points. How are you going to trade even just one of those? Is there a better way for you or a way that you don't like that you want to avoid? Are you going to use the dome? Are you going to use bracket orders? Have you found old examples of it? What time frame would you want to trade on? And since price isn't expected to stop right on the line, what's the rules about getting in before it hits the line? What's the rules to get in after it hits the line? These rules should, again, come from your research, from the questions that you ask and the answers that you find within the price action. It should not come from somebody else who says, well, I trade it like this. Now, you can get insight from that, right? I could show you trades that I've taken and you could see what I've done and then modify that to fit you. Of course, because we're all going to learn from examples of others. But you wouldn't want to just take my playbook word for word and try to do what I do. That wouldn't work, right? You need a playbook written by you and designed for you so that it uses language that you understand, it uses words that you understand, and it has research that you've done so that you understand the things that are written in there. Check the various time frames and see if the behavior exists on those other time frames. Identify if those other time frames offer a better or at least a different trade that may have different restrictions and maybe even different difficulty levels. Record all of that data and add it to your existing knowledge base on that trade. Remember, it's a research project, and the goal is to teach you about a thing that you're trying to learn. So when you've done all the work, you should have a more informed opinion about the trade that you've been focused on. After all of that work, develop a trade plan to take advantage of the information that you've learned. Then trade that plan. Take pictures of the trades, review these trades for insight. During that review process, start asking new questions. Did the trade behavior follow through, right? If it was supposed to bounce, did it bounce? If that was a reversal zone, did it reverse? Did your participation work out the way that you had anticipated, right? Did your trade actually perform as it was designed? If you bailed out early, was there a specific price action or told you that that it was time to get out? Or did you just get out of because of fear? Right? And this has happened to all of us at some point. Price will just shake you out. You'll start to believe that the trade isn't going to work. Something has gone wrong and you want to get the heck out before it gets worse. But when you review the trade, you really want to go back and ask yourself, what was that signal? What made me get out? Because if it was just fear, well, we can work on that, right? You can work on that. You can work on getting past that fear and looking for correct exit signals that say, hey, I had a plan. I was going to hold until it got to A, but I had to get out early because of this signal that I saw, whatever that happens to be. Did you stay in the trade longer than your original exit plan? What was it about this trade that told you to stay in longer than the original exit plan? Is this something that makes you want to reevaluate your original target, right? Was you off in your assessment? You thought it could go 5 points and it went 15? Or did you think it could go 5 points and when you got there, you saw that things were working out really well and you just hung on and rode it for more and it was a fluke and just luck? You really want to have an answer to that, because if you can stay in longer, you definitely want to. But on the other hand, you want to really have a good reason to stay in longer. You want some signal so that later on in a different trade, maybe that signal is going to help you stay in that trade longer. Also, think about your original exit point. Are you really aiming too close? And maybe should you push your target farther out? These are questions that you would want to answer through the review process. After reviewing your trade, reset and evaluate your trade strategy. Do you need to make any changes? Now, I will put a little asterisk here and say, don't make drastic changes to your plan. Trade for a while, get yourself a good number of occurrences, say 10, 15, 20 trades. And at the end of those 20 trades, you're going to have a very informed opinion about your strategy at this point. Make adjustments, but make small adjustments, and then give that a good number of occurrences, 10, 15, 20. And at the end of that, you will again, hopefully, have an informed opinion about the change that you've made. Was it a good change? Did it help you accomplish the reason you made the change in the first place? And if not, what do you need to change now to continue to help you improve things? Trade again. Take pictures and review your trade. Make notes on the trade that you took. Are things continuing to prove that this is a good market behavior? Are you improving at taking this trade? What else can you do to improve even more? And then repeat that process. Number 9, trade, take pictures. 7, 8, 9 should be done again and again. 7, 8, 9. Just keep circling back, doing it again, doing it again. What eventually happens is you become very good at that one trade, whatever that trade may be. In this video, I used a pivot point for an example, mainly because there's a lot of them and we get at least one pivot point every day to trade. But by no means is it the only thing out there that I would want to trade. And it's not even maybe the best thing out there to trade. It's just one example. The goal here would be that you eventually build a whole playbook of known trades, of researched, documented, well-established trades that you now fully understand 100% before you take the trade. All right, so that's it, everybody. Short and sweet. How to trade paper, part 3, futures.